Welcome to The Explainer. Today we're diving into a really cool hedge fund strategy that's built on a super strange paradox. I mean, why would a company ever sell something for less than it's actually worth? It's called convertible bond arbitrage, and we're going to break down exactly how it all works, step by step.
So let's start right there. Why would a company do this? It sounds totally backwards, right? But believe it or not, the answer to that question is where this entire strategy, this massive financial opportunity is hiding. So let's crack it open. Okay, so the secret here lies with companies that, well, let's just say they're not exactly the prom kings of Wall Street. Picture a company with a kind of shaky credit rating. They need to base cash, right? But for them, just borrowing money the normal way is either really tough or just crazy expensive.
And this really spells out the corner they're backed into. If they try to issue a normal, straightforward bond, investors are going to look at them, see the risk, and demand a super high interest rate to compensate. I mean, painfully high. But there's a clever little workaround they can use to bring that cost way down.
And this is where the magic happens. They add what's called a sweetener. They tell investors, hey, we'll also give you the option, not the obligation, but the right to swap this bond for our company's stock, but only if the stock price really takes off. It's like throwing in a free lottery ticket with the deal, and that potential upside makes the whole thing a lot more appealing. All right, so what are you actually getting when you buy one of these things? Let's take a look under the hood of this 2-for-1 deal.
The easiest way to think about it is like this. You're buying one thing, but it's really made of two separate parts. You've got your safe, kind of boring bond that just pays you regular interest, and then, stapled to it, you've got that lottery ticket, that exciting bet on the company's stock going to the moon.
Now that lottery ticket has a proper name in finance. It's a call option. And it's a really powerful little thing. All it means is you get the right to buy the stock at a price that's already set in stone, no matter how high it goes. It's how you capture all that juicy upside.
And here it is. This is the absolute key to the entire strategy. To make sure people buy these bonds, the investment bankers who put the deal together, they often sell that little embedded lottery ticket too cheaply. They underprice it to make sure the sale goes off without a hitch. And that small, almost hidden mispricing, that's the crack in the system that arbitrageurs are looking for.
Okay, so we found the opportunity, the cheap option. How does a hedge fund actually grab it? Let's walk through the actual playbook. This is how they set up the trade to lock in that value and get rid of all the other risks.
It's a really clean 3-step process. Step 1, you buy the convertible bond, because that's where the cheap option is hiding. Step 2, you isolate that option in your mind. That's the prize. And step 3, the most important part, you hedge away all the stuff you don't want. You short sell the company's stock to protect yourself from it going up or down.
So what's the goal of all this? You want to be what's called delta neutral. Now that sounds super technical, but all it means is you've set things up so you literally do not care if the stock price goes up or down. You've taken guessing out of the equation entirely. And you can see that perfect balance right here. Your long position, which is the value you get from the bond's option, is matched by an equal and opposite short position from selling the stock. It's like putting equal weights on both sides of a scale. They just cancel each other out, leaving you perfectly neutral.
Right. So if you don't care if the stock goes up or down, how in the world do you make any money? This is my favorite part. The profit isn't about where the stock is going. It's about the fact that it's moving at all. You get paid for the wiggles, the volatility.
So let's watch this little profit engine in action. Say the stock price goes up. All of a sudden, that option you own is worth more. Your perfect hedge is now broken. It's unbalanced. You're now leaning a little too much to the long side.
So what do? To get back to neutral, you have to sell more shares. And here's the key. You're selling them at this new, higher price. Just remember that part.
Okay, now let's say the stock price drops instead. Uh-oh, your scales are unbalanced again. But this time, they've tipped in the other direction. You're now a little too short the stock.
And to fix it, to get back to neutral, you have to buy back some of those shares you shorted earlier. And here, this is the magic moment, you're buying them back at a lower price than you sold them for. And that difference? That's a small, locked-in profit. You just bought low and sold high.
This whole process of constantly adjusting your hedge, selling more shares when the price goes up, buying them back when it goes down, that has a name. It's called gamma scalping. And by doing this over and over, day after day, you've literally built a little machine that skims profits off the natural ups and downs of the stock.
Okay, now it's time for a reality check. This isn't a free lunch. As clean as it looks on a whiteboard, in the real world, this strategy has some pretty serious risks you absolutely have to watch out for.
First off, that whole short-selling thing is a pain. I mean, you have to find someone willing to lend you the shares in the first place, and you have to pay them for it. If the stock pays a dividend, guess who pays it? You do. And then there's the big scary one, the risk of a short squeeze, where the stock price just explodes upwards and you're forced to buy back shares at a massive, massive loss.
But you know what the number one biggest risk is? It takes us right back to the very beginning. Remember why this opportunity even exists? It's because the company has a shaky credit rating. The single biggest danger is that the company just goes bankrupt. If that happens, your bond, your main investment, could be worth zero. Game over.
So that leaves us with a really fascinating final thought, right? This whole strategy only works because there's a little bit of a disconnect between the bond market and the stock market. They're not perfectly in sync. And you have to wonder, in today's world of supercomputers and hyper-efficient markets, how do these little gaps even still exist? It just goes to show you that even now, there are still profits to be made hiding in plain sight right in the cracks between different markets.